everyone, welcome to this series of videos about strategic leadership. And in this fourth video, we're going to talk about the basics of business models and some definitions that you need to know before we move forward with our lectures. So first of all, let's talk about business model. What is a business model? It's a conception of how strategies should work together as a whole to enable the company to achieve a competitive advantage. Now, this means that business model is basically how all the strategies, normally a company has more than one strategy going on, and it's about how do they all work together to generate the competitive advantage we want. In other words, it answers the question of how we're going to make money. So the business model will deal with a variety of things. It will deal, for example, there's going to be strategies about how to select, acquire, and keep customers. How do we define and differentiate the products we have? How do we create value for the customers? How do we produce goods or services and deliver them to the market? How do we lower costs and organize our resources and activities? How do we achieve and sustain high profitability and growth? So all of this has to do, it's a big question of the business model. So whenever we say we need to develop business model, what we're answering is all these questions and actually more. It really depends on the company and on the idea you're trying to develop. But I would say that the most important thing is to indeed, the big topic of a business model answers the question, how do we make money? So one of the things obviously is profitability and return on investment that we're trying to generate, and different business models have different profitabilities. Now, for example, here we have a graph between the year 2002 and 2011, so before and after the financial crisis of 2008-2009. And what we see is that indeed there are a lot of different industries here, but there's a couple of points I want to bring. Now, this graph gives us a huge amount of information, but we have to think about it. All right. So, for example, what we see is that air transport and hotel and gambling, which is defined here as the blue and the green line. What we see is that they were the ones that had the biggest decrease of profitability during those years, but at the same time, after 2009, they were the ones that recovered the fastest compared to other industries. So therefore, these industries are extremely volatile and are extremely affected by the conditions of the world, as we see now, for example, during the COVID-19 pandemic that's going on in the world. These two industries have suffered a lot. But during this crisis, there's not all companies or industries actually lose money. If you notice, for example, the drug and the computer software profitability increased quite a lot. Now, the drug profitability increasing during the 2007-2008 might have to do, for example, with the fact that during those years there was a lot of unemployment, a lot of people got depressed, and maybe they were using more drugs to be able to survive. But computer software, you might think, why did computer software increase? Well, when sales start to go down, as we know, there's two ways to make money. We can increase our sales, or we can try to focus on becoming more efficient and therefore decreasing our costs. Now, during a crisis, you cannot increase the sales. It's going to be very hard to increase the sales. So what do you try to do? You try to increase your efficiency by eliminating costs that maybe you don't need. And one of the ways you can do that is, for example, substituting people with computer software that becomes automated. And although the investment is higher in the beginning, you end up recovering the money because you don't have to pay those salaries every month, for example. So indeed, there's a lot of interesting data in this graph over here. We also see more long-term trends. For example, we see that the profitability of drug companies actually has been decreasing through the years here. We see that retail, for example, it's quite constant, I would say. Computer software is been increasing their profitability for many years. So indeed, as you can see, there's quite a lot of different aspects in this graph we could analyze. Now, another thing that I want to talk about is that there are different levels of managers. Now, we all know about general managers, and general managers bear responsibility for company overall performance or for one of its major contained subunits or divisions. So a general manager is responsible for a strategic component of the industry. Now, there are general managers responsible for divisions like marketing. There are general managers responsible for the whole business. Another one that we need to know is what we call functional managers. Now, functional managers are responsible for supervising a particular function, task, activity, operation, or team. So they're responsible for much more operational sides, and you might have functional managers, for example, of production in specific parts of the production cycle. You might have functional managers, for example, a sales manager that has to supervise a team of salespeople, for example, would be a functional manager because they're responsible for a direct task. Another thing that I want to talk about before we move on is the proper definition of multi-divisional company. So a multi-divisional company is a company that competes in several different businesses and has a separate self-containing division to manage each one of them. And just as a quick example, I put here, for example, the company PepsiCo. So Pepsi has many different brands, and by far it's not just the ones you see over here. So you have Lay's, Pepsi, Tropicana, you have many different ones. Now, Pepsi is a true multi-divisional company because they divide their corporation into each one of the brands, and each one of the brands has a little bit of independence from the others. The way, for example, that Lay's will have its own marketing, finance department, HR department, so on, so on, so on, and Pepsi will have their own marketing, finance, so on, and so on. So what we see here is that yes, they all belong to one company, but they operate a little bit more independently when it comes to decisions of marketing, finance, and most of their departments. So corporate level managers, they really have a lot of stuff that they do. Their responsibility is to oversee the development of strategies for the entire organization. So therefore, they have a very high role in the set of the direction that the company will take. Most people that become managers or most enthusiastic people want to become a general manager or a corporate level manager because normally this is the ones that have the very high salaries that we see. But they have a lot of responsibility, but they also, it's still a very people-oriented business on the sense that they are a link between the people that are concerned with the firm's strategic development and the shareholders. In other words, they are the link or the face of the decisions made every day in the company and the shareholders. And normally, if a company is not going the direction shareholders want, the one that gets eliminated typically is the corporate level managers because they are the ones that should set the correct direction. They also need to ensure that the business strategies pursued by the company are consistent with maximizing profitability and profit growth, because at the end of the day, they have a responsibility towards the shareholders, the ones that invested their capital and money on the business, and therefore they have to make sure to achieve those two goals to pay back, let's say, the trust deposit on them. Business level managers is a little bit different. They are heads of business units. For example, you might have the CEO of PepsiCo, but then you're going to have the business level manager for Lay's, for Tropicana, for Lipton, and so on. So a business unit is a self-contained division that provides a specific product or service for a particular market. And they are responsible for that, and their objective is to translate the statements or the intents into concrete strategies for each individual business. What does that mean? It means that, for example, if you are the manager of Lay's, you get your orders or you get your goals and objectives for the business from the corporate level, but it's then your job to see how can your business achieve those goals set. You have to translate the things that they want into the reality of your own business. So obviously they are much more concerned with strategies that are specific to their own business, not so much to other businesses that would not affect. Functional level managers, they are responsible for specific business functions and they develop functional strategies to fulfill the strategic objectives set by business and corporate level strategies. So for example, the business level manager might say to the sales director that they want to increase sales by 10%. But it's the responsible of the sales manager or the sales director to translate into their sales team how they're going to do that and what will be the goal of each one of the individual salesmen, for example, to achieve in order to be able to achieve an overall increase of 10 or 20% as defined before. So again, you're translating the orders or you're translating the strategy that comes to you still very broad, and you translate it into something much more specific for each person that will need to be done. They also provide information that helps formulate more realistic and attainable strategies. They are really a key resource in the company because most of the times they are in direct contact either with the customer or with the people that are in contact with the customer. So a lot of times they have a better notion of what is possible to do or not than the corporate level manager. So to summarize, business model indeed will break down the strategies that a business must operate in order to achieve their goals. But it's going to be up to the managers to decipher those strategies and put them into action. From corporate level managers to business level managers to functional level managers, each one of them will have a very important role to play, and we cannot negate that. If you eliminate or if you try to ignore one of these sides, then the probability that your strategy will fail is much higher. So thank you very much for watching, guys, and let me know if you have any questions on the comment section below.